All right, stocks finished the week on a little bit of a roller coaster ride. We started pre-market with a good move to the upside, filled in that gap with a pretty decent move to the downside throughout the day, looking like we might finish the week with a fifth straight loss before rallying up above yesterday's high, and closing near today's high today by the end. So really good. I mean, in fact, it's the third, from what I saw online, it's the third straight 1% or more increase on a Friday. And we haven't seen that in a long time, like 15 years. And we've never ever seen a four Friday in a row streak. So we're on a pretty good stretch right now of Fridays. Unfortunately, the market was down the other 4 days this week. And we have a big week next week with earnings, more earnings, and CPI on Thursday. So we're going to break down how the market looks like from a technical perspective going into next week. What are our expectations? Of course, you always get that out of me. What's driving the market? Big move in commodities today. We'll break that down. How that jives with what the dollar is. What we can expect to see from bonds. Some pretty interesting moves from bonds. A common pattern over the past few months related to the past year to date. And then we'll take a look at a trade idea in a retailer that's about as flat as can be going into its earnings announcement. We'll talk about how to trade that. So let's go ahead and get started. Today is Friday, November the 4th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon right here and the red subscribe button down below the video. Hit the thumbs up icon down there to like our video today. Comment on anything that stood out to you. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching our video here on our blog, check out some of these things on our right. Our Market Outlook live video where I do the trades during the day, at the end of the day. Also our upcoming classes. Click this heart icon, it opens up this tab, hit the like button. Click this thumbs up icon, opens up this tab, hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. We hit the 100 mark again, that's great. I appreciate that. Let's see if we can do that again on this one. So as you're watching right now, just come down and you can click on these right now while you're watching. Also wanted to give a quick shout out to Mary and to Paul. Again, we appreciate the support there. And again, if you'd like to support our YouTube channel and show your support for these videos we do day in and day out, you can do that right here through the Super Thanks feature on YouTube. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So we rallied today by the end of the day today and did not follow through on the selling from the previous few days. That would have been all 5 days to the downside for this week after the breakout, right? Last Friday's breakout move on the Apple earnings, getting us up above these levels, but then not holding, right? And we talked about how the volume just was not supporting this move. Very, very little volume on the rally. And you can see now in just 1 week getting a pretty bearish near-term peak. So it was a divergent near-term high. I think we talked about that earlier, like on Wednesday in the Market Outlook. And then it didn't stay in bullish territory for very long. And then it's down now. It got down, you can see the dotted blue line. That's how far down the near-term line has gotten. You can see it doesn't get down this low unless it's starting a new bearish move, right? You can see there. You can see here it got down this low when we started the bearish decline. You can see here it got down this low right there when it started the bearish decline. Over here it got down that low when it started the bearish decline. So the dotted line is as far down as it got, pretty much to the 5th percentile. And so even though it rallied a little bit today, and we're back above the 30-day moving average just barely by 1.1%, it's still, the intermediate line is now falling. So we got the pink shading. It's falling, and so when I say that the near-term line is bearish, when you get barely above the 80th percentile and you don't stay there for very long, just a day, we were just in bullish territory for a day. Well, it's the same way for the intermediate line. See, these intermediate lines, at least they got above 80 and stayed there for a while. This one just barely got above 80, and now it's already falling. So pretty bearish intermediate peak too, potentially, what you're seeing there. So with the near-term line as low as it is, the intermediate line already coming out from being above the 80th percentile. It's not a good look for next week, going into next week. Let's take a look at the weekly, or let's look at the NASDAQ first and the Russell, and then we'll look at the others. So the NASDAQ, you can see its intermediate posture we're back to dark pink shading in a red line. So we're bearish already on the NASDAQ. We are back into bearish territory, and of course extreme lows on the extreme lows there on that. If you look at the Russell 2000, it's a little different. It's light pink shading. It's much further above the 30-day moving average than the S&P was. And you can see the short-term sentiment wasn't as extreme on the near-term basis. In fact, it's a little bit bullish. We've seen it before. It's usually not during bullish moves that it's this down, but it's not down to extreme lows. The momentum line got down there, but not the Russell 2000. So it's not as bad. Let's look at the Dow Jones. It's the most bullish index. You can see its intermediate line still easily above 80, right? And short-term sentiment also is not that bearish. And you can see we're well above the moving average, still 6% above the moving average. And we're well above that 62% retracement of this current intermediate decline. We're trying to get above the 78. The 62 is a resistance. It got above it, came back down yesterday, got back above it today. Just for some comparison's sake, the S&P 500, being above the 62% level for the S&P would mean that we were above 4,000 on the S&P, and you can see we're not even close. So we had gotten above the 38, and unlike the Dow, which did get above its 62% retracement, the S&P did not get above the 38% retracement. So, a little bit more bearish, and of course the Nasdaq's even worse because it's the most bearish. It's down below the 23, so it never did get above the 38 at all. Remember, so the Dow is above its 62% retracement, so it would be way up here at 12,500. We're below 11,000, and we're below the 23% line, which means we're done retracing. This was all the retracement we got. We never did get a bullish intermediate run, and we're already to being bearish. So, you would expect, especially considering the biggest market cap names in the S&P 500 are in the NASDAQ 100, so you'd expect that this is the way the biggest names are going, that the rest of the market will follow suit, especially with Apple. Why Apple's the big dog in the market, and you can see it fell today. It's been the most bearish. It fell today, and it was actually at one point in time flirting with lower close than what we had in October. It rallied at the end of the day like the rest of the market. But you can see here when you look at the retracement, we did get above the 38% retracement of its current intermediate decline. You're back below the 23, and you had flirted with getting below this low point there. So Apple is leading the market to the downside. This is by far the biggest move. And sometimes Apple may move on its own, right? It might have its own issues that won't necessarily be impacting other companies. It might be just impacting Apple individually, but that's not the case right now. It's more, anything that may be affecting Apple right now negatively will be affecting the rest of the market as a whole. Let's take a look at the S&P 500 on the weekly market forecast chart, and you can see, so just to kind of give you some context, the Dow Jones Industrial Average, the most bullish one, got another bear tag. So again, a bear tag on the weekly chart has got very important ramifications, because either it will lead to new highs, like a correction, or it starts a bear market. So we've already had one, and the initial response to that one was bearish. And here we are again. And so far, the initial response to that has not been bullish. It's been more bearish. Now, we haven't crossed, it's only 1 week, so we'll see if we follow through. See, it took a couple of weeks to get going, so we'll see if we can, what happens next week. But I would expect, especially considering the S&P never did get that bearish tag, and the intermediate line's actually still in the reversal zone, so you still got dark pink shading and a red line. And then you look at your NASDAQ 100, and it's even worse, right? It's the near-term line formed a bearish peak here, and which suggests that we would follow more to the downside, follow up on this. to the downside. Finally, the Russell 2000. You can see it didn't quite. It missed the bear tag because you have to have the light green shading and the yellow line together. By the time we got the light green shading this week, we were back below the moving average. We were above it. So kind of a quasi bear tag. And again, either it will lead us to new highs by by however, not the end of the year, but beginning of next year, or it will, start a bear market. And so considering what the S&P and the Nasdaq are doing, we would suggest it would be the latter option, not the former. Looking at the this chart here, we finished the week with a red arrow. So we got that green arrow, bullish candle, feeling really good about ourselves last week. This week, a lower close with an upper and a lower shadow, so a transition candle with a red arrow. So again, where are we going to be? So we're going to open next week at 37.86. Right now we're trading at 37.70. So depending upon how bearish we are on Monday, remember we got CPI next week. Depending upon how bearish we are, we could have a bearish candle that pretty much reverses this. Of course, you would also see that on the weekly hull. When you look at the hull, you are still, like the 20-week hull is still bearish. You still have the bearish parabolic SAR. You had tried to reverse. You're still above the 20-week, but we got the lower, the lower candle, and now we'll see if we get the red candle to follow, to complete the reversal pattern there. Let's take a look at some of the other oscillators. Let's start with the green arrow charts. So the Nasdaq has got 3 red arrows again, and now has had it for 3 days. So it's not just it's not just a 1 or 2 day phenomenon here. You're in a downtrend. You got 3. You had 3 green arrows briefly for a couple of days, and now we're reversed it. You don't have 3 green arrows anymore on the S&P, but you don't have the red either. You have 2. You don't have any reds on the Dow. And you only have 2 on IWM. They just barely came up today. So you just barely stopped being green on the Russell. You barely stopped being green yesterday on the S&P. And the Qs went straight from 3 greens to 3 reds. And maintaining that. So you can kind of see the reversal sign. The MACD's rolling over on all of these. So, we are turning bearish there. You are in the S&P. You are back below the 17-day. Yesterday we rose up above the 17. I got all the way up to about the 8 today with a little bit of long lower shadow. The MACD is still below its moving average. Stochastics are still falling. In fact, when you look at the stochastics separately, where we're closing relative to the range, yesterday we actually closed back below the moving average. Now we held up today. The question is going to be, are we going to be able to stay up and follow up on this, or continue lower? I expect it will continue lower on Monday into next week, but you can see getting back below this orange line on the blue line, which is essentially where we're closing relative to the 4-week range, that would be bearish. And if you look at the this chart here, we did avoid closing. I mean, we were below last week's low. We weren't below yesterday's low, but we were below last week's low. That was pretty bearish. We avoided that, and not only did we avoid not closing below last week's low, we actually got above yesterday's high. So it's actually relatively big. I mean, it wasn't as close to the high point of the day, but it was, we filled in the gap. We filled in both gaps yesterday and today, and we finished above yesterday's high. So it's actually higher high, higher low, and closed above yesterday's high. It's actually relatively bullish. And now the question is whether that will stay there, and whether we'll be able to break through this low point, if and when we break through that, because that will be next week's low point. This low point right here, it would be yesterday's low, because that's going to impact the Arun, right? So I'm not too worried about a bearish breakdown until the green gets below 70 and the red gets to 0. So that will happen. You can see right now we're at 84. So when you're at 84, you have right there, you have 1, 2, 3 more days. So on Wednesday next week, the green line will be below 70. And the red line, which is at 15 right now, it takes 1, 2, 3 more days to get to 0. So by next Wednesday, barring a new 4-week high point, which I doubt we'll get, we will have the conditions for a new 4-week low point to occur by the end of the week, right? To get the spike. It doesn't have to happen immediately when it crosses below, but you can see like right here, it only took another day or two, and you got it. They kind of give you an idea of where, where we'd be. So, 1, 2, 3, 4, 5 days. Next week is where the low point. So after that, the low moves up, right? After this comes off, the low will move up, and after that, the low moves up all the way up to here. So you can see like it gets really easy to get a new 4-week low point by the end of next week, the beginning of the week after, if we haven't gotten a new 4-week high point by then. So that's really, really important. And there's a pretty big gap in volume. There's a pretty good resistance above us because we had so much time up there. And there's a relatively decent resistance or support below us. And we're kind of in the middle. The question is, by the end of the week, where are we going to be? Because Thursday is that CPI, right? So Thursday is going to be a really important day as to whether or not, how likely the Fed is to be, getting us another 75 basis. Because right now it's a pretty much 50-50 proposition here for a rate hike next year. Let's see if I were to go to the odds. Looks like we are at, as of right now, pretty much a 50-50 coin flip. The futures market is pricing in a 50-50 coin flip as to where we'll be 75 basis points. If you look at the bond market, and that's up, right? So if you look at the historical, 75 basis points is 475. So that's this one right here. And right now we're, 50-50 split. This was actually going into November the 2nd, so that's going to be updated here. Let's see if it's updated yet through today. Still only updated through the 2nd. But remember, it's up to 48 right now. And so, just at the beginning of the month, at the last meeting, September 21st, the odds that we would have a 75 in November and then the 75 here in December was 0.67%. And now it's at 48%. So the odds have increased that we would get another 75 basis point hike by then from where it was. And so, again, you can kind of see that, that I think we have a CPI report the day of the FOMC or pretty close to it in December, on December the 14th. So that can impact things then. There's going to be around there. So you might have 2 reports by the time the next meeting comes around. But this one's going to set the direction for the going into November expiration and the Thanksgiving holiday as to how bullish or bearish we're going to be. Which is probably why you have your VIX as low as it is. You can see the VIX always pretty much finishes Fridays at a low point. But the VIX is really low. Like the VIX dropped to below 25. It dropped below the 95% mark, so we're in neutral areas at 93. But what really stands out is the volatility of the VIX. Earlier today it was at 77. Like we haven't been below 77 since February of 2019. Back then the VIX was below 15, and right now we're at 25. There's a big divergence between the volatility of the VIX and the VIX now when you look at the comparison here. Here, let me pull this up and I can share this with you. When you look at the comparison of the volatility of the VIX, let's see if I can find it here. Here it is. You can see how, like, while the volatility of the VIX has been really dropping sharply lower over the course of the past, so this is a weekly chart, you can see that the VIX has actually gone higher. It's gotten higher lows and is much higher now than where it was, say, at the beginning of the year when we had that low point on the VIX right there. The volatility of the VIX was was also bottoming out at the same time, right around 110 maybe. Now we are much higher than that low on the VIX, and we're bottoming at 77 with a correlation, year-to-date correlation. 44 weeks is how many weeks we have. So year-to-date correlation is really, really low levels when it's normally pretty darn high, easily above 75% most of the time. So again, as this correlation resolves itself and both these indicators go in the same direction, considering the volatility of the VIX is as low as it is, and it bounces, then that would suggest the VIX also bounces. But The problem is the VIX would be bouncing from a much, much higher low than what we've seen before. And that's a concern because it can lead to a much higher high than what we've seen before. I also showed this chart here about the compression of the volatility index. All right, let me see if I can, this one here. So you can see volatility, when you look at the volatility index with its ATR, with this normalized ATR that we have on our Market Scholars charts. Here we go. So you can see it's not surprising for the VIX to compress. The ATR falling relative to the value. That's how that's normalized. It's not, it's not surprise for the VIX to compress, and it takes a pretty decent amount of time. When it expands very quickly, and then it takes a much longer to compress. It expands very quickly, takes much longer to compress. It expands very quickly, takes much longer to compress. It expands very quickly here late last year, and has since taken a long time to compress. But unlike all these other moves, when you compress, the VIX drops. VIX drops, VIX drops, VIX drops, VIX drops, VIX drops. But here, you've had this expansion and compression, but the VIX hasn't dropped. In fact, it's been really flat. So again, we would be coming off of a higher low point than any of these other compression levels. And not only that, but your VIX 6M, which is what I brought up here it is. The VIX 6M right now at 27.5 is higher than the peaks at the end of the 15-16 correction and the end of the Q4 2018 correction. It's higher. Now, typically, when we have these big spikes in volatility, the VIX spikes too, and the VIX is higher than the VIX 6M. That's normal when you get volatility spikes. But that's not the case right now. Right now, the VIX 6M is higher than those two levels, and the VIX itself is lower than... Here we go. Sorry about that. The VIX itself is actually lower at 20. It's under 25 now. This is earlier in the day. But the VIX is lower than with the VIX 6M, which means the market is still more worried about what will happen in the next 6 months than what's going on right now. There's complacency now, and there's big concern, more concern about the next 6 months than what you saw during the worst of the last two corrections. And that says something in terms of, because this should be dropping. As low as the VVIX is, as low as the VIX is, this should be much lower. If we are indeed bottoming out right now at the end of a correction, this should be much lower. If we're bottoming out, the concern of the next 6 months, pretty much everybody should be really bullish, because 6 month returns after you've had, however much of a pullback are generally really good. Just look at all the tweets that Ryan Dietrich puts out there about how bullish we are after certain amount of bearishness that he's got really good data for all of that. So the VIX 6M should be really low at the end of, when we are washing out at the end of a correction, bottoming out. So if we have bottomed out, that should be the case right now. It's not the case right now. The reason why the VIX ratio is as low as it is here, as high as it is because, or as low as it's not, because it's not getting up here to these capitulation levels, is because the VIX 3M and 6M are still very high, which means the market is still concerned about long-term declines, not just immediate declines, which is what the VIX measures. All right, let's take a look now at how what's driving the markets today. You look at this big move up that we had in commodities today. This is a 3-month chart again. Commodities and the dollar. They've been the story year to date, right? When you go year to date, those are the two asset classes that have been killing everything, and everything else is down, including long-term bonds being down the most. TLT is down more than Qs, and IWM's now only down 20%. So the IWM's really started to outpace the Qs over the last little bit. But let's go back to that 3-month chart, and you can see that divergence. The Qs are down 18%, IWM's only down 5%, along with gold. But you can see bonds are down 21% in 3 months. TLT is down 21%. Real estate is down 16% in 3 months. So you have real estate and large cap tech, which has been a safe haven in the past, and long-term bonds. These are all safe haven trades. In a regular risk-off environment, when people flee equities and commodities, they go into these areas along with the dollar. And at least the Qs previously, over the past so many years, has been a safe haven, the mega cap names. Not the case right now. The market is fleeing safe haven in a risk-off environment, right? Because stocks are down too, with the dollar being bullish, and like I said, commodities being bullish. In fact, with this little dip in the dollar today and rise in commodities, when you look at the commodity index, I tweeted this out earlier today, that's a pretty big breakout in commodity prices there. You broke above the 200-day moving average. You broke above the 23% retracement. That retracement goes back to the COVID low point. So we have been retracing slightly below the 23 and below the 200-day. The 200-day now itself is above the 23% retracement, and now you're back up above it with a rising PPO. So you do have it's a good bullish sign. And then when you look at it a little bit closer, you can see that the 8-day and 17-day have crossed above the 30. They have now since crossed above the 50. And the 30 is about to cross above the 50. That's how far up above. And you can see that's a pretty decent sized gap. And when you look at, the gaps down here, you can see it's one of the bigger gaps, a 3% gap to the upside that we've seen since things really started to get bullish for commodities back in February. So really good gap to the upside, held most of the gains, didn't really build on the gains, but held most of those gains today and pushed higher. And that was with the dollar only dropping slightly at the beginning of the day. By the end of the day, you can see you ended up down 2%. You're still at the 50-day moving average. But again, we've talked about this before. If the dollar is going to be dropping, that has a bullish effect on commodity prices. So that's going to mean commodity prices are going to rise. And remember, the 10-year yield does not have a lot of downside to it because, as you saw, it's a 50-50 coin flip between 4.5 and 4.75. It's rare. It's not common. It's not uncommon for there to be a big inversion between the 2-year and the 10-year. It is uncommon by the time you get to the Fed meeting for there to be a decent inversion between the Fed funds and the 10-year, especially if they're still raising. And if you look at if you wonder how much more do they have left to raise, well, when you look at the spread, let's see here. I had it up here. Maybe I got to come back over here and add in the 3-month again. And when you add in, not that one. When you add in the 3-month spread, here we go. Add that in there and then put the spread formula in. You can see that like right now, the spread between the 2-year and the 3-month, so the 3-month is a good indication of where the Fed is currently, as they're moving, and the 2-year is a good idea of where the Fed's going to be. So the 2-year is down a little bit today. It's at 4.7%, 4.65. The 3-month is down a little bit too, and it's down at 4.11. So you're looking at about a 54 basis point spread. So this is, as of yesterday, it was 46. So now we're at the 54 basis point spread there. So the Fed's not anywhere done to closing that gap yet. The last FOMC meeting we had was September 21st. So the market started to price in what we got, here a couple days ago. Since then, and now it's a matter of, okay, well, are we gonna go up again? We went up a few days, and then we started to falter. How much, how far are we gonna fall as the 3-month finally catches up? I mean, this is, we were pretty high. That was a really, really high. Like the Fed. What this basically said is the Fed was really slow in raising rates compared to where the 2-year said we should have been. And they finally started to close that gap. See, the 2-year, when you look at when the 2-year started to rise, it started to rise back here in 2021, and the Fed didn't raise rates again until March. The Fed was really behind the curve, according to this spread. But now they're not so much. I mean, again, you go back to 2013. They were kind of behind the curve over here, and they started to raise rates in December 2015. Finally, it was when they raised rates for the first time. Then they raised rates again in December 2016, and then they started that rate hike cycle. They kind of paused, And then in 2018, they raised rates every single month, every single quarter in 2018 until they got to December. Here in December, by the time they got to this point, they raised rates that last time. They actually said they would continue to look at it, but by the time they got to 2019, that spread was gone. So they stopped. They stopped raising rates. The market bottomed out in early 2019 or Christmas Eve of 2014, and then we rallied. Well, we're not anywhere close to that yet. So that kind of gives you an idea of how much more the Fed has to raise rates. Like I said, coin flip, and then you can see what's going on there. So there's not much downside right now to the 10-year yield. And that's the basis, right? That's the idea that, oh, well, if commodities are going to fall and yields are going to fall, the market's going to be bullish. Well, commodities are not falling. In fact, they're rising, and they had a really good week this week. Here's our weekly chart, and you can see getting back above the 17-week. The MACD is above its moving average. So you've got this is kind of a breakout week for commodities. And then, like I said, the dollar is dropping, but still at the 8 week, so it's got a long ways to go before it even starts to retrace, right? It's got to get below that 23% line to start a retracement. It's not there yet. And then the 10-year yield is not going to drop anytime soon. At best, it's just going to kind of go sideways as the Fed kind of pauses on its rate hikes, as long as the 2-year stays flat. Let's take a look at how the sectors performed here recently. So let's go to... sorry, it's on this one. The sector comparison, and look at energies, it's taking off like a rocket. And again, not necessarily what you want to see from a Fed standpoint, right? The Fed doesn't want to see commodities taking off because that's, again, a reflection of rising inflation expectations. And you can see the big three are down here at the bottom over the last 3 months. XLK, XLY, XLC. They still make up over 40% of the S&P 500 by themselves, with real estate down here too. And we all know how important real estate is to the broader market. You have this kind of quote-unquote reopen trade. They don't really use that terminology anymore. They used it quite a bit in 2021. When financials, industrials, materials, and energy rallied, that was your reopen trade. And they seem to, they had their time, but obviously that kind of pricked the bubble, so to speak, and we... by the end of 2021, we had peaked and we had started to fall. So it's not necessarily the best leadership we want to see from a market standpoint. From a market cap weighted standpoint, you would much prefer to see these three down here at the bottom leading the way up to the upside. And you just aren't seeing that. When you look at their relative rotation graph for the S&P 500, U.S. international stocks are showing some really good relative strength, but when you look at the sector rotations here, and this would be through August 31st, so it's not updated yet for this week. Let's see if it's updated for the daily. It is updated through today on the daily chart. You can see XLK, XLY, XLC moving down to the left. Utilities and real estate moving up to the right, and staples moving up to the right. That's risk off. You also have financials and industrials, healthcare moving up too. Again, the quote-unquote reopen trade. But not good to see staples, real estate, utilities moving up to the right, and discretionary communication services and technology moving down to the left on a daily basis. So you see the rotation into safe havens as we are peaking here and rolling over right now. All right, so for our trade idea of the day, I wanted to take a look at Target. Target has been an interesting, it's got earnings coming up here soon before the November expiration date. Obviously, we're looking at December expiration right now for trades, but you see how sideways it's been. Obviously, it's very similar to the broader market. The intermediate line's falling, short-term sentiment's slightly rising. You're sitting right around a flat moving average. When you look at some of these kind of trend strength indicators, you can see we're sitting right at the point of control. Bandwidth is flat, falling. We're sitting right in the middle of the bandwidth there. And when you look at the trend strength, there's no trend strength. We're in the cloud. The cloud's pretty flat. There's just nothing going on. The RSI and the CCI, you can see, are kind of sideways too. So really kind of flat move. There's not very much of a trend moving on here. We have been basing. We've been kind of in this convergence mode because you're rising here, but you're not above the 40-week moving average yet. but you are rising. So you're in a convergence mode, so to speak, while we're basing, and right around this area, right around that point of control. So of course, in a situation like that, especially with earnings coming up, a good opportunity to do is look at an iron condor spread. So I sold the low 20 on the delta, went over here a little bit higher on the delta, and sold the 20 deltas there too. Went one strike away for risk protection. And you can see I did my position size, only a couple contracts because I got a normal return for less than 2/3 of my risk. That's typical for an earning setup. There's more risk involved with earnings, so I'm going for less risk than normal to get my normal return to compensate. So worst case scenario, best case scenario is I get my normal return. Worst case scenario is I lose 2/3. Of course, I want to try to get out by only losing 390. But you also notice I'm right smack dab in the middle. My break evens are at the 50% retracement there and at the lows of the year there. And I'm sitting right now, currently sitting right smack dab in the middle of that range, right at the point of control. So, I mean, there is no better setup than you could possibly have there. And so that's why we ended up doing this iron condor, again, with the idea that worst case, if it breaks out with earnings, I lose 610, which is less than a full risk. But best case, but I would prefer to only lose 390 out of that 610, and then the best case is I get my normal reward there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have, or apply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join our website at marketscholars.com. Like us on Twitter and Facebook. Have a great rest of your weekend, everybody, and we'll see you all next week.